Hello, Bulls and Bears. We are back with another dose of economic reality. It's Saturday, March 25th, 2023. A lot going on, a lot of news to cover with you today. But here's what I think we're headed for. We're headed for emergency rate cuts. And I think these will be happening by the end of summer. So I'd say at the latest August. But of course, it could happen much sooner because the latest would be August. Emergency rate cuts. Why do I say that? Well, that's what's happened every other time where things started to fall apart. In this case, the banks are falling apart, and therefore the economy is falling apart. Now, we knew the economy has already been falling apart because so many people are dependent on debt, on taking out debt and spending themselves into debt just to maintain their current standard of living. So the economy has been falling apart, but it's getting to a point now where it's becoming obvious even to the norms out there that don't really follow this type of information or this type of news when they see bank failures in the headline. We have Credit Suisse over in Switzerland had to be taken over. Now, it's interesting when you look at the interview about that bank failing, Credit Suisse. What they're saying is, this is the finance minister. She defended the merger between the country's two largest banks in an interview with the Swiss newspaper, saying the use of emergency law was necessary to stabilize the situation. Quote, Credit Suisse would not have survived Monday without the takeover, without the rescue. But it's interesting, they're not calling Credit Suisse a failed bank, right? So think about this. If let's say you're trying to swim across a lake because you think you're a great swimmer, you're in great shape, you're going to swim across the whole lake. Not Lake Michigan, but maybe a smaller lake but you start going underwater and you have to be rescued, right? So now people have to come out in the boat, they have to dive under, bring you up, put a life raft on you, drag you in the boat, take you to shore in the boat, and you get to the shore and you're like, I made it. I didn't have to be rescued. Well, no, you failed. You had to be rescued. That's not making it. You made it to shore, but you made it to shore because you were rescued. In this case, Credit Suisse failed. They had to be rescued. So to me, that's a bank failure. It's just interesting that the media is not really reporting it as a failure. So they're saying, oh, it was taken over, it was bought out, merger, whatever word you want to use, any word but failure. As far as I could see, they're trying to keep that calmness amongst the population, in my opinion. But we're headed for emergency rate cuts. We're in a crisis situation right now. The financial crisis is unfolding. People are realizing it now, and they're taking money out of the bank. In fact, per Bloomberg here, U.S. bank deposits decline by the most in 1 year. And this has only been a couple weeks since the panic began. Of course, the regulators are out there, the talking heads are out there trying to keep everyone as calm as possible. But this is the biggest withdrawal of funds in a year, and we've only gotten started. Just wait until more news of distressed banks comes out, and you're going to see things likely get much, much worse as far as failures. More people taking their money out of the banks, putting their money in the too big to fail financial institutions. Now, many people say there's not going to be emergency rate cuts because they say that this is a plan. They're going to let all these smaller banks fail so they can consolidate all the entire population to just a handful of a few too big to fail banks. And they're saying the reason they believe this is because, for example, Janet Yellen came out and she said, we may come to the rescue of regional and smaller banks if we decide they're systemically important enough or that the failure of those banks may cause contagion. We could come to the rescue, is what she said, and cover those depositors. So obviously she poured gas on the fire there. She's not trying to stop the panic. She's not trying to stop the loss of confidence in the banking system. If she wanted to completely make everyone confident, she would have said, definitely every depositor at every bank, small bank, credit union, mid-sized bank, regional bank, every depositor is going to be covered 100% guaranteed. That's all she would have had to do to make everyone confident. Now, I still wouldn't have believed her myself personally, but if she wanted to calm, most of the population that was concerned about the bank failing, that's all she would have had to do. That's all she would have had to say. But she didn't say that. She said, we may come to the rescue if we decide. It has to be a super majority, is what she said, a super majority of regulators amongst several different agencies would have to come together, convene rather, and come up to that decision. All right. So obviously they're not trying to stop this from happening. And you could say, oh, she just doesn't know what she's talking about. That wasn't her intention. Well, if it wasn't her intention, that's a scary thing too, for the Treasury Secretary not to know what they're talking about. To me, that's even scarier, right? So pick your poison here. But, we're headed into this collapse, folks. And I think emergency rate cuts are coming. Will the rate cuts be enough to prevent a collapse? Now, I think it's too little too late. You could take interest rates all the way back down to near zero, like we've had for 10 plus years before this. And I don't think it's going to stop the bleeding here. And, this is what's happened in the past. There's always emergency rate cuts. Now, this time could be different. Most of you have probably heard the term, this time it's different. Most of the time that's used in a comforting way. This time it's different. There's not going to be a collapse. So this time it's different. Are they going to let all these banks fail and just have the handful of survivors, the too big to fail banks? If that's the case, then we've got a whole new ballgame ahead of us here. Now let's talk about what came out on Reuters here about some of the too big to fail mega banks. Citi, Chase, and Bank of America are warning their employees not to cause more panic to customers. So when they're interacting with customers to try to get a sale or try to get customer to open up an account, they're not supposed to say that the customer's current bank, which may be a small bank or credit union, they're not supposed to tell the customers that their bank may be insolvent. They're not supposed to even mention that because they're not supposed to cause panic. And they don't want to use that as an unfair way to gain more market share. Well, they're already gaining the market share just because of the panic that's been put out there by the fact that there was no guarantee of the depositors being covered beyond 250,000. It was going to have to be a super majority. So, but that's what these institutions are doing and telling their staff not to cause even more panic on top of the panic and the loss of confidence that's already being implemented by the talking heads. Now, how does that affect you and me? Well, we are likely going to see, if this happens, if the banks start failing in mass and consolidation begins even worse at the handful of too big to fail mega banks, then we're likely going to see credit contract. And we're already seeing credit contraction. Now, so far, it looks like just the smaller and regional banks are contracting credit because they're concerned that they are over leveraged. And no credit unions are not immune to this. Credit unions also loan out money they don't have. They have the same type of lending as the mega banks. It's just that it's not as leveraged, but it is leveraged. So in other words, the small banks, the credit unions, they're also insolvent. They don't have enough funds in the banks to cover if everyone took their money out at once. They don't have enough funds in their banks to cover if all loans started to go bad. If people stopped paying back their loans, they would fail right away. They would become insolvent. So they may not be as leveraged as the too big to fail banks, but they're still leveraged and they're still insolvent at the end of the day when you look at their obligations and their liabilities versus their deposits. So therefore, people will continue to pull money out of these banks, I think, and go to the big mega banks. But how does this affect us? Well, if credit tightens, if you have less banks out there, it's going to be harder to get a loan, and therefore you could see some falling prices. So therefore, if you don't have cash, it's going to be very, very difficult to get a loan if credit tightens up. And that looks to be what's happening so far, as I've read stories here, and I've even read some of your comments saying it's harder to get a loan. Even myself with an 821 credit score, the best interest rate I could get on a vehicle loan was 7.2%. I got one offer from CarMax. It was like 8.2, 8.3. I checked a couple more. The best I could get was 7.2%. And I don't like to go out and pay cash for things because I like to have some cash on the sidelines in case of an emergency, in case a good investment opportunity comes up. So if an interest rate's low enough, sometimes it makes sense to finance something instead of getting rid of all your liquid cash. But yeah, even a 821 credit score in my case, a very high interest rate. So it's going to be very difficult to get a good rate and even get a loan in some cases if credit contracts, which it looks like it's what's happening right now. We're just at the beginning. And as I mentioned earlier, we saw the biggest drop in bank deposits, and that's causing banks to panic, especially the regional, the smaller, the mid-size, and even the local bank. All right, let's talk about what Fidelity came out and said. A major investment firm, Fidelity, they do 401k, retirement funds, and more. out of Fox Business here. Most Americans falling short of affording basic expenses in retirement. Fidelity said that. Most Americans. So people are falling further and further behind. The people out there that say everything's fine, I'm seeing less people now saying I'm wrong. I used to, every video I'd see people saying you're wrong, everything's fine, the economy's strong. Now, not so many. So maybe people are worried about their money sitting in one of these banks. But we all knew this was coming. So I would say prepare for both scenarios. If you have cash on the side, have some in case of a good buying opportunity headed towards us here, but also prepare for inflation, because if they go ahead and just pump trillions upon trillions of dollars into this to keep the banks solvent and to bail out every depositor, then you're likely going to see inflation, right? So they would have to come out and really instill confidence that depositors will be covered to keep the bank contagion, to keep the failures from spreading. But if they don't do that, then we're going to continue to see the contagion cause more bank failures, right? So it could go either way. It depends on what the regulators do, what the talking heads do, and what they say. And we're just going to keep an eye on it here for you, try to help you navigate this. In the meantime, keep stacking, and we'll be back very soon. We'll probably be back for tomorrow, a Sunday update, and I hope to see you here then. Thanks, everybody, for watching. Keep stacking. Bye for now. Peace.